Hello and welcome to BOSS Educational Material. This video will help you to understand the concept of cost and revenue and its relevance for the success of your business opportunity. The revenue is the total income your business opportunity will generate year after year, while the cost refers to all expenses you must consider to deliver the solution to your customers. At the end of the day, any business opportunity has to generate profits in order to be sustainable or to have a chance to be supported. In the business plan, a financial sheet must show the profit that will be generated over the years. The profit is calculated by deducting all the cost from the total income. The financial plan typically presents losses during the first years and turns to positive figures after the so-called operational break-even point. This period before break-even is called the death valley and will determine the funding structure of your project. The first part is about evaluating the total revenue of the business opportunity. Typically, the selling price of the product or the service multiplied by the number of sold products or services. It seems easy, but the hypotheses you base your plan on are decisive. Market evaluation, achievable customers, quantities to sell, time to market, time to customer, consumer reactions. In addition, the type of business will also determine the way to evaluate the total income. So, for a software-based company, you will consider license fees, maintenance fees, trainings, or services. For a pharma company, milestones, sales, royalties. For a service company, manpower and expertise. For a device-based company, sales revenue, maintenance fee, or consumable. The financial plan should assess the evolution of the income in the first years by summing all expected revenue. Furthermore, there are various structures of costs that depend on the business sector. The project can be capital intensive or manpower intensive, depending on the balance between operational cost, overhead cost, and investment cost. For service providers, the revenue will be almost proportional to the available manpower, while the required investment is quite low. In software business, the R&D investment can be high, but the required infrastructure is normally cheap. Pharma business requires heavy R&D investment for the product itself, but also for validation, for regulatory affairs, for the production tool, and all the investments must be realized before selling the first item. When you deduct the cost from the revenue, you get the generated profit and loss, P&L, year after year. The first step is to come with positive figures for the operational P&L, without taking investment into account. That's the operational break-even point. In the second step, you take the investment into account through the depreciation, and the global break-even point can be calculated. Finally, you can choose an appropriate legal envelope for embedding the business and for sharing the responsibilities and the profits between stakeholders. If you want to know more about this topic, you can explore educational resources provided on the BOSS platform. You can also always contact knowledge transfer professionals at your institution to discuss about your business opportunity.